Hello, I'm really happy to have Tim Bray, co-CIO at NS Partners, with me in Cape Town in person. Thanks for coming all the way from the UK.
It's a pleasure to be here, Rob.
We've had some interesting times in markets around the world, and in particular in global emerging markets. Tim is, as I said, co-CIO at NS Partners, and they are the portfolio managers on our Ned Group Investments Global Emerging Markets Equity Fund. I'm going to ask him to run through a few slides with you now, where he'll be touching on the recent performance, some of the drivers of those performance, and the positioning of the portfolio as we look forward, and what might be changing in the environment and the financial markets within emerging markets around the world. So I'll hand on to you now, Tim, and I'll come back and throw a few tough questions at you in a few minutes.
Thanks very much. So let's start by looking at the performance of the fund, and you can see that we've got a range of time periods here from quarter to date since inception. The story for emerging markets has been a tough one in the last couple of years, and you can see year to date emerging markets are now down nearly 30% on the portfolio and 27% for the fund. So we're slightly underperforming year to date, but since inception we're still comfortably ahead of the benchmark, although it's a sorry thing to see negative returns. So I'm going to talk a little bit later about why we think that might change. Obviously this is potentially a good entry point for emerging markets, and there's the chance now, I think, that emerging markets might perform better relative to developed markets going forward. So just to recap who NS Partners are, we're an independent money manager based in London. Currently we have assets under management of about 4.2 billion, of which about 1.8 billion is invested in this emerging market strategy I'm going to talk about today. It's encouraging to note that we still see really strong interest in emerging markets and good inflows into our funds and into our EM product. A lot of CIOs, I think, are seeing this as an opportunity to buy, and what has been an underperforming asset class for a few years now. So potentially a good entry point. So let's just take a sort of a big overview look at what happened in the last quarter, Q3 of 2022, and you can see that it was a tough quarter. We were kind of close to in line with the benchmark, but down near close to 12%. What was going against us? Well, certainly security selection in China, where we had more cyclicals. Our cyclical stocks tended to underperform, so that was a negative. The underweight in the Gulf and Brazil was also a negative, and overweight and security selection in consumer discretionary in IT and security stock picks in the financials also hurt performance. On the positive side, security selection in India and Brazil was good, and actually the overweight there in India and also in Indonesia was a positive contributor in terms of performance attribution. The overweight in staples and security selection was good, and security selection in communication services, healthcare and energy were all good. So we like to, when we're presenting this overview, just kind of focus in on some of the good and some of the bad. So three bad here, all kind of China related. I mentioned security selection in China was a negative, and Xpeng is a EV car maker, and obviously the weaker Chinese economy there was holding that one back. Alibaba, a name I'm sure some of you are familiar with, also impacted by the weak Chinese economy, and there was concerns about whether there'd be any kind of threat to the ADR being delisted in the US, and also SoftBank were selling a stake there, so that came under pressure. And AIA is an insurance company that was hit hard by the news of the continued COVID lockdowns in major cities such as Shanghai. So those three were negatives of note in the portfolio. On the positive side, they're actually all in India this time. Stock selection was good in India, helped by Varun Beverages, which is a Pepsi Cola bottler, which has done very well for the portfolio over a number of years, and they're continuing to see really good strong profits growth as they take more and more market share in India. Lemon Tree Hotels is a mid-size hotel operator. Again, as that economy reopens and you're seeing more tourism and more business activity, Lemon Tree's really recovered very strongly. And then Max Healthcare, a big growth story for us in India is the improving healthcare system. And this is a manager of hospitals in Delhi, and they have a very strong portfolio of healthcare properties with growing occupancy, and the complexity of the operations they're performing there is increasing, and that helps margins. So Max Healthcare, another long-term winning story on the portfolio. What have we done? We've added modestly to China, and we've also reduced the underweight in South Africa by adding FirstRand. We've also reduced India, taking some profits there, and Thailand and in Indonesia as well. So let's just have a look at performance by country, and you can see here that the standout there over the quarter was China underperforming, and in contrast Brazil and India were doing better. Brazil surprised. We'll see the money numbers later for Brazil. And they look pretty shocking. Money supply is contracting in Brazil. We expect the economy to be weak as a result next year. But the market had a decent rally because of what was going on politically. There was a presidential first round between Lula and Bolsonaro. And the Congress they also had elections. And they turned out to be a little bit more right-leaning and business-friendly than was expected. So I think the market's saying there this outcome isn't quite as bad as we thought. There's going to have to be another runoff between Lula and Bolsonaro. Lula's likely to win, but that more centre right-wing leaning Congress will restrain some of his more left-wing policies. So Brazil surprised us and did well in Q3. But other markets there, you can see Korea, their economy is slowing, and so that was a bit of an underperformer. Also challenges there in the semiconductor industry. And Mexico did a little bit better in the second chart. So attribution by country. You can see, as I mentioned, stock selection in China was the big negative over the quarter. We did much better in terms of stock selection and the fact that we were overweight in India. Indonesia was also a positive, good stock selection there. It was a miss not owning the Gulf markets, and it was a miss being underweight Brazil, although our stocks did well there. In terms of sector selection, you can see energy surprising on the upside, given that the oil price was actually down about 23% over the quarter. So energy is still holding up and still attracting investor attention and capital. On the downside, you can see that we've got consumer discretionary underperforming in the quarter. And that's a reflection of rising interest rates and worries about consumer sentiment really globally. Financials did better. Rising interest rates mean higher net interest margins and net interest income. So banks, beneficiary of rising rates. And on the downside there, you can see healthcare was a little bit softer. So next up, we look at the attribution for sectors. And what you can see here is that our stock picks did well in consumer staples and healthcare, but things were a little bit tougher in financials and in other areas such as industrials and consumer discretionary. So now looking at the winners and losers by stock. We've touched on some of these already. We talked about Varun and Lemon Tree and Max Healthcare. Telecom Indonesia is a really high quality name in Indonesia. It's the major telecom service provider and has been performing very well along with within a strong market. And Bharti Airtel is another telecom, and telecom tends to be defensive. So it's been a weak quarter. So these two telecom names have held up much better. Bharti has obviously operations right across Africa as well as India, and is growing very nicely as well. On the downside, we touched on the Xpeng and Alibaba and AIA, all kind of China-related stories. Longy Green's also another Chinese story, and then CTBC has been slightly disappointing in Taiwan. So. Just to remind you what our kind of style is, we focus on quality growth stocks, and you can see here that leads us to be kind of overweight the growth factor and the profit factor, which reflects our focus on return on invested capital, and we're underweight leverage, which speaks to the quality of the portfolio. We're also underweight value and underweight dividend yield. So as interest rates have risen globally, it's been a tough time for our style. Our quality growth style has had that headwind of rising bond yields, rising interest rates, which does tend to impact negatively long duration stocks, higher valued stocks. So we're kind of hanging in there relative to the benchmark, but it's been a tough time for our style. So in terms of transactions, You've got Nari Technology, which is a manufacturer of power grid automation. This is sort of feeding into the desire for China to be self-sufficient, and this is a smart grid play. Container Corp of India is a play on the freight corridor investment and privatization in India. That's growing very nicely, got a great return coming through there. Contemporary Amrex, that's leading battery manufacturer, supplies Tesla. That's a great EV story there. LG Energy Solutions, another EV story, another battery maker but this time in South Korea. And Alibaba. Some of these names, some of these tech names have been hit so hard by the tougher regulation that's been put in place in China over recent years. But we think we're at peak negative regulation impact in China, and these stocks look incredibly cheap. They're great businesses and they're growing. And so the likes of Alibaba and others like JD.com and also Tencent, look very attractive to us and should do better if the global liquidity picture starts to improve. So next up, we've got the largest sales for this quarter, and you can see we've taken some money out of Korea where we're expecting the economy to slow. Also, emphasis in India is impacted by a slower US economy, and a couple of sales there in China as well, and profit taking in Indonesia. So how does that leave the portfolio? Well, it leaves us just slightly just underweight China. But if anything, we're looking to add there as the liquidity picture improves. And if you add in that Hong Kong position, actually it's an overweight. Indonesia is still an overweight for us, but coming down. India is an overweight. And the biggest underweights are obviously in places like the Gulf markets, where we're still very concerned about the potential downside in the oil price because of a weaker global economy. And also we don't like the companies there because of governance issues. We've just added back a little bit to South Africa, as I mentioned earlier, and we're underweight Latin America, mainly through the underweight in Brazil. In terms of sectors, underweight energy and materials. So the focus for us really is now thinking about adding to more areas that benefit from an improvement in the liquidity background. We want to be underweight cyclicals, so no surprises, underweight energy, underweight materials. We still like consumer discretionary, really on stock-specific basis. And we're small overweight in communication services. A bit of cash there that is transitional. We'll be looking to put that to work over the next quarter. So what's happening in the big picture? Well, truth is, you can see here the 6-month change. Sorry, the year-on-year change in global manufacturing PMIs. And the G7 and E7 real narrow money. So the narrow money measure here has led the PMIs down, and that is signalling a recession globally. And part of the story here is the stock building cycle. That's about to roll over, and that's going to be putting a negative pressure on economic activity over the next 3 years or so as stocks are run down. And stocks coming down tends to lead to weaker commodity prices. So we're expecting commodity prices to remain soft and continue to fall. So money trends are signaling, and this is very important, a decline in inflation. So you can see here broad money has fallen significantly since that huge injection of liquidity to head off the COVID crisis. So back to where we were pre-COVID. So that signals to us that by 23-24, you're going to see inflation back to that 2.5% level that we're sort of so used to pre-COVID. Now, the standout difference with the money growth numbers is actually China, where the money growth looks much, much stronger than the US and other developed economies, and indeed other emerging market economies. So that's a positive for China, and it's part of what we're basing our overweight position on. Money trends also suggest stable PMI for China relative to other global markets. And, there is policy support. I know a lot of people will be concerned about what's going on in the property market, and there are undoubtedly issues. But in a Chinese way, they'll work through those issues over a long time. And part of the story is easing. So while the rest of the world is putting up interest rates and tightening, they're actually easing in China. So once we through those COVID restrictions, we think that this excess liquidity and the easing is going to be supportive of what has been a very weak market. And of course, the currency is pretty stable as well, so we're pretty relaxed about the currency. And the balance of payments is fine. We're portfolio flows. As far as other markets are concerned, You can see that money growth is very weak, and I touched on the weakness of money numbers in Brazil. That certainly signals a weak economy in Brazil next year. So, to sum up, we have the difficult message of saying that a global recession is underway, but global real money momentum is possibly bottoming, but no economic recovery to at least the second half of next year. So it's tough times economically, but there is going to be relief in terms of the inflation numbers, and we're expecting inflation to fall reasonably significantly in the first half of next year. And that's a part of the story here is the stock building cycle. It's going to be in a downswing that's going to hurt economic activity, but it will put downward pressure on prices. Now, China, as we said, is got some real money momentum, and if we see better money numbers continuing to come through there, that's a signal to add here. And the RMB is stable versus its basket, and we're obviously, as a result of having a fairly pessimistic view on the global economy, we're cautious on cyclical markets, the commodity producers, and sectors. So we're looking more to add now to countries that benefit from that improvement in global liquidity, which is going to come about from lower inflation. So thanks very much.
Thank you very much, Tim. A lot of information in there, some really good nuggets for us to get a good understanding of what's going on in the portfolio. Obviously, right now, what's going on is the National Congress in China, and we've already seen some fairly provocative comments from Xi Jinping. What's your take on that? Is that going to add to uncertainty for emerging markets, or are you still fairly positive that your overweight position will be okay?
Yeah, I mean, the comments on Taiwan are always going to attract all the media attention. They were pretty consistent with what's been said before. There was also a lot of focus on the real economy, and China wants to invest in things like science and education, and become much more independent. There's obviously a bit of a war going on in the semiconductor industry, and so self-sufficiency is a really important thing for China. And we're always looking to buy companies, buy stocks that are actually helping the Chinese government achieve their goals. We think they're the ones that will outperform. So we're looking at new economy stocks, green economy stocks, and so we don't see any significant change in the situation with Taiwan. It's he's made a commitment that he wants it resolved by this administration. It's not a problem that's to be left for future generations. But I suspect he's going to be around for 10 years, so that could be some way off.
Okay, thanks very much. And something you didn't touch on today, but we've chatted about, is the relative valuation of EM versus DM. Do you see that the prospects for EM going into the future, maybe into next year, are actually slightly more positive?
We do. So certainly valuations, if you look at the forward PE, certainly favour emerging markets. The money growth is much stronger in emerging markets. And the key really is the US dollar. Now, as inflation rolls over and as the US economy enters into recession, that might convince the Fed to just slow down the rate of the pace of interest rate rises and then even maybe pause. And so that might turn the dollar. The dollar is very overvalued and a key for relative performance is key for relative performance for emerging markets. So if the dollar rolls over, we think you could start to see some relative outperformance of emerging markets versus developed markets, which is a reversal of really a trend that's been in place now for something like 8 or 9 years.
And just quickly, last question, are we seeing any weakness in earnings in emerging markets? Is that coming through yet?
I mean, the headline numbers really aren't, both in developed markets and in emerging markets, haven't really come down as much as you'd think. There are certain sectors that have done well and offset the weakness in others. So energy's done well. You see better earnings numbers coming from the banks because obviously interest rates have risen, so their interest rate margins have risen and there's no real bad debt issue. But you have to say that there's going to be downgrades coming through. The analysts probably haven't caught up with that yet, so we're cautious for next year, 2023. We are going to see some earnings downgrades from here, but if they're not too bad and not really significant, then the actual change there might be more than offset by a re-rating upwards as finally we get interest rates stabilising and starting maybe to pull back in terms of the bond market.
Well, thanks very much, Tim. And once again, thanks for joining us in person in South Africa. It's a real treat to have you here.
It's my pleasure, Rob. It's great to be here.